You think land is about farming. It's not. It's about control. And right now, China is quietly buying pieces of the world that most people don't even know are for sale. While you were watching stock tickers and crypto charts, Beijing has been accumulating something far more permanent: ports, farmland, entire cities, infrastructure that doesn't just generate returns, it generates dependency. This isn't investment, it's positioning. And the countries selling don't realize they're not just selling land, they're selling leverage. If you think this doesn't affect you because you don't live in Sri Lanka or Angola, you're missing the pattern, because the same strategy that turned a port into a 99-year lease is the same one reshaping global trade routes, food supplies, and who controls the choke points of the next economy. In this video, I'm going to show you three things. First, what China is actually buying, not the headlines, not the hype. The real deals, the real scale, and why most of what you've heard is either exaggerated or completely wrong. Second, why they're doing it. And no, it's not just food security. That's the cover story. The real motivations are older than empires and simpler than you think. Third, what this means for you. Because whether you hold dollars, stocks, or property in a Western country, this strategy is already affecting your wealth. You just don't see it yet. This is not financial advice. This is pattern recognition. Let's start with what actually happened. 2017, Sri Lanka. The government is drowning in debt it can't repay. The country had borrowed heavily from China to build a massive port in Hambantota, a city on the southern coast. The project cost billions. The port was supposed to bring prosperity, jobs, and trade. It didn't. The port sat mostly empty. The loans came due. Sri Lanka couldn't pay, so China made an offer. Not a bailout, a swap. In exchange for debt relief, China Merchants Port Holdings would take control of the port. Not for 10 years, not for 20, for 99 years. Let me repeat that. A Chinese state-owned company now controls a strategic port on one of the world's busiest shipping lanes for the next century. This wasn't a bankruptcy. This was a transfer of sovereignty dressed up as a business deal. And here's what most people miss. Hambantota wasn't a mistake. It was a blueprint. The same pattern is playing out across continents. Pakistan, Greece, Angola, Djibouti, different countries, different assets, same mechanism. This is the story nobody's connecting. Because when you hear China buying land, you think farms, you think food. You're looking at the wrong asset class entirely. Let me explain the mechanism, because once you see it, you'll recognize it everywhere. Step 1. China offers financing for infrastructure. A port, a railway, a power plant. The terms look generous. Low interest, long timeline, technical expertise included. Step 2. The project gets built. Chinese contractors do the work. Chinese equipment gets used. The money flows in a circle. Beijing to the borrowing country, then back to Chinese companies. Step 3. The project underperforms, or the country hits economic trouble. Debt payments become impossible. Step 4. Renegotiation, but not forgiveness. Equity swaps, long-term leases, control. This is called debt for equity, and it's not new. The British Empire used it. The IMF uses versions of it, but China has industrialized the model. Think of it like this. Imagine you have a neighbor who's struggling financially. You offer to build them a garage they can't afford. You hire your own construction company. You loan them the money at friendly rates. Then when they can't pay, you say, no problem, I'll take the garage. Actually, I'll take the driveway too, for the next 99 years. That's the model. And it's not just ports. Between 2010 and 2016, Chinese foreign investment in agriculture and related sectors grew fivefold. By 2016, roughly 1,300 Chinese enterprises held overseas investments in agriculture, forestry, and fishing worth $26 billion. But here's the critical detail. That's not just farmland. It's processing facilities, supply agreements, joint ventures, commodity trading operations. The Chinese government explicitly tells its companies to make use of foreign resources and secure imports. Beijing organizes credit lines, they broker deals, they arrange strategic partnerships. This isn't free market capitalism, this is state-directed economic expansion with geopolitical objectives. Now let's separate the myth from the reality, because the media has made this story almost useless. Myth: China is buying up all the farmland in Africa and America. Reality: massively overstated. In the US, Chinese-owned farmland is 277,000 acres as of 2023. That's 0.02% of American agricultural land. It's statistically irrelevant. In Africa, early reports screamed about millions of hectares. Researchers on the ground found the actual controlled acreage was around 240,000 hectares by 2014. Many megadeals were announced but never completed. Some collapsed due to local resistance. Others never broke ground. So if it's not farmland, what is it? Infrastructure. Strategic infrastructure. Between 2011 and 2020, Chinese companies gained control of 6.48 million hectares hectares of foreign land. But most of that? Forestry concessions, mining operations, not wheat fields. The agriculture investments that did materialize are concentrated in specific regions: Southeast Asia for rice, rubber, and cassava; Russia's Far East for grains; select African nations for sugar, palm oil, and cotton. And even there, the model shifted. By 2018, most Chinese investors weren't clearing land for massive new plantations. They were doing contract farming, joint ventures with local farmers, buying existing operations. Why? Because outright land ownership creates political backlash, but owning the supply chain? That's invisible. Here's what China actually controls: the processing plants that turn raw crops into exports, the logistics companies that move goods to ports, the trading firms that buy commodities in bulk, the ports themselves. They don't need to own the farm if they own everything that happens after harvest. Now let's talk about the Belt and Road Initiative. You've heard the name. You probably think it's just about trade. It's not. Belt and Road is a $1 trillion infrastructure project spanning over 130 countries. Roads, railways, ports, pipelines, telecom networks, power plants. China frames it as mutual development, win-win cooperation. And for some countries, it has brought real economic growth. But look at the fine print. These projects are financed by Chinese loans, built by Chinese companies, often secured by the revenue streams of the infrastructure itself, or by collateral like natural resources. When countries can't pay, China doesn't seize assets like a bank. It takes control, management rights, operational authority, long-term leases. Let me give you the concrete examples. Gwadar Port in Pakistan, a deep water port that was a fishing village 20 years ago. Now it's a special economic zone with 923 hectares leased to China for 43 years. It's also a critical link in China's energy supply route. Oil from the Persian Gulf can now reach western China without going through the Malacca Strait. Piraeus Port in Greece. China's COSCO acquired a 67% stake in 2016. It's now the largest port in Greece and the fourth largest in Europe. Chinese control of a European gateway, the Addis Ababa-Djibouti Railway, Chinese-built, Chinese-operated, connecting landlocked Ethiopia to the sea, and conveniently, China also has its first overseas military base in Djibouti. In Angola, a Chinese state company built an entire city. Quilamba, also called Quilamba New City, over 30 square kilometers, cost $3.5 billion. It was built to house 500,000 people as part of Angola's post-war reconstruction. But Angola couldn't fill it or pay for it. Now it stands as a monument to Chinese construction capacity and Angolan debt. See the pattern? These aren't just investments. They're footholds. They're leverage points. They're pieces on a global chessboard. Now, China does talk about food security, and they're not lying. It's just not the whole truth. China has 20% of the world's population, but only 7% of its arable land. Domestic grain production has plateaued. Imports have climbed. The government is genuinely concerned about feeding 1.4 billion people if global supply chains break. So yes, securing foreign food supplies is part of the strategy. But here's what they're not saying. Food security and geopolitical control are the same thing. If you control where food is grown, how it's processed, and how it moves across borders, you don't just feed your own people, you gain leverage over everyone else in the system. China isn't just trying to avoid starvation. They're trying to avoid dependence. And in the process, they're creating a system where others depend on them. Look at Latin America. China is the top trading partner for Brazil, Argentina, Chile. They buy soybeans, copper, beef, but they don't own Brazilian farms. Brazilian law restricts that. Instead, Chinese firms finance soybean processors. They invest in cattle feedlots. They control the export terminals. Same result, less visibility. In New Zealand and Australia, Chinese dairy companies and agribusinesses have purchased farms outright to supply China's milk and meat markets, not because they couldn't buy those products on the open market, but because ownership guarantees supply and eliminates intermediaries. This is vertical integration at the national level. So that was the buildup. Now let's talk about 2025. China's land strategy has matured. The early phase, roughly 2008 to 2016, was aggressive and visible. Big announcements, mega deals. A lot of them fell through. Local backlash slowed things down. Media exposure created political resistance in host countries. But Beijing learned. The strategy got quieter, more targeted, more sophisticated. Instead of announcing billion-dollar farmland acquisitions, Chinese firms now do quiet joint ventures. Instead of owning the land, they own the output through long-term supply contracts. In regions where laws restrict foreign ownership, like the US and Europe, China pivots to adjacent assets: food processing companies, logistics networks, distribution infrastructure. In 2016, a Chinese equipment maker bought 1,700 hectares hectares of French cereal farmland. It was unprecedented. It triggered political concern. It remains an outlier because China realized that buying a farm in France creates headlines. Buying a food distribution company in France does not. Meanwhile, the infrastructure strategy accelerated. Right now, Chinese firms control or co-manage major ports in Djibouti, Tanzania, Kenya, Sri Lanka, Pakistan, and Greece. They've built railways across East Africa, connecting resource-rich regions to those ports. In Southeast Asia, Chinese agribusiness investments continue to grow. Rice paddies in Cambodia, rubber plantations in Laos, pig farms in Vietnam. In Central Asia, Chinese firms are studying irrigation projects and grain production in Kazakhstan and Uzbekistan. And while Western governments were distracted by the word farmland, China secured the big pieces, the choke points, the infrastructure that everything else flows through. Here's the kicker. China isn't trying to replace domestic food production. They're building redundancy, multiple suppliers, multiple routes, multiple options, so that if one country cuts them off, 10 others can step in, so that if one trade route closes, 3 others remain open. This is what food security looks like at the nation-state level. It's not about owning every farm, it's about owning enough of the system that you can never be starved out. And in the process, they've built leverage over dozens of countries. You might be thinking, I live in Texas, or London, or Toronto. Why do I care about a port in Sri Lanka? Because the global economy is a closed system. When one player controls critical infrastructure, they control prices, they control access, they control leverage. Here's a simple example. If China controls the ports in East Africa and the railways that move goods to those ports, they effectively control the cost of shipping for every company that does business in that region. That affects the price of coffee, minerals, oil, which affects your grocery bill, your gas prices, the returns on your investments in companies that depend on those supply chains, but it goes deeper than prices. Imagine a scenario where tensions rise between China and the West. Trade restrictions, sanctions, retaliation. Now imagine China controls ports in Greece, Pakistan, Sri Lanka, and Djibouti. They manage railways across Africa and Central Asia. They have stakes in power grids and telecom networks in dozens of countries. What kind of pressure can they apply? What kind of deals can they force? What kind of access can they deny? This is geopolitical leverage, and leverage is power. If you hold assets denominated in dollars, and the dollar's strength depends on global trade flowing smoothly through systems the US influences, then you need to pay attention when another country starts building a parallel system, because that's what this is. China isn't trying to join the American-led order, it's building an alternative, and every port, every railway, every supply agreement is a piece of that alternative system. The transition won't be sudden, you won't wake up one morning to a new world order, but 10 years from now, the global economy might be split into 2 spheres of influence, and if you're not prepared for that, you'll be on the wrong side of the shift. So let's be clear about who wins and who loses from this strategy. China wins, obviously. They secure resource access, diversify supply chains, reduce dependency on US-controlled systems, and gain geopolitical leverage without firing a shot. Chinese state-owned enterprises win. They get government-backed financing, guaranteed contracts, and global expansion opportunities that private companies could never access. Some host countries win, at least in the short term. They get infrastructure they couldn't afford otherwise, jobs during construction, economic activity, improved logistics. But here's who loses. Countries that take on debt they can't repay lose sovereignty. They trade short-term growth for long-term dependence. And once you're dependent, you can't say no. Local populations in some regions lose. Large-scale land deals can displace small farmers. Infrastructure projects often import Chinese workers rather than hiring locally. Profits flow back to Beijing, not into the community. Western investors lose influence. As China builds alternative trade routes and financial systems, dollar dominance erodes. It's slow, but it's steady. And the dollar's role as the global reserve currency depends on the dollar being the currency that facilitates global trade. If China creates a parallel system, that role weakens, and everyday people in the West lose optionality. If the global system fractures into a US-led bloc and a China-led bloc, supply chains become less efficient. Costs rise, stability decreases, your purchasing power erodes. You don't feel it yet because these shifts take years to materialize, but the foundation is moving, and when the ground shifts slowly, people don't notice until the building starts to crack. All right, let's get practical, because I'm not here to just scare you. I'm here to help you see clearly so you can act intelligently. First, understand where your wealth is positioned. If you're 100% in dollar-denominated assets, stocks, bonds, savings accounts, you're making a single bet. You're betting on continued dollar dominance and stable US-led global trade. That bet might pay off, but it's not a certainty. It's a bet. Consider consider diversification, not panic selling everything, not going all in on gold or Bitcoin, but some exposure to hard assets, international holdings, or commodities that hold value regardless of which system dominates. Second, pay attention to supply chains. If you run a business or work in an industry dependent on global trade, understand where your inputs come from and which infrastructure they travel through. Map out the choke points, identify alternative suppliers. Redundancy is expensive, but dependency is riskier, and dependency on infrastructure controlled by a single nation is the riskiest position of all. Third, watch the debt. Countries that owe money to China are the ones most likely to make concessions when pressure is applied. If you invest in emerging markets or hold bonds from developing nations, know who holds their debt, because debt is leverage, and leverage gets used. Fourth, recognize that this isn't a short-term trade. This is a multi-decade strategy. You're not going to wake up tomorrow to a crisis. There's no single catalyst date, but 10 years from now, the world will look different. And the people who prepared, the ones who diversified, who understood the shift, who didn't assume stability was permanent, will be fine. The ones who didn't will be scrambling to adjust in the middle of the transition. Fifth, educate yourself on how these systems actually work. Understand what makes the dollar valuable. Understand what gives infrastructure strategic value. Understand why ports and railways matter more than farmland. Because once you see the game, you can't unsee it, and you'll stop being surprised by what comes next. Not financial advice. Do your own research. Talk to professionals who understand geopolitics and macro trends, but don't ignore the pattern just because it's slow moving. Slow doesn't mean harmless, it just means you have time to prepare. Now, if this sounds like fear-mongering or conspiracy theory to you, let me address that directly. Everything I've told you is documented. The Hambantota port lease is public record. The Belt and Road Initiative is official Chinese government policy. The debt for equity swaps are analyzed by organizations like the Center for Strategic and International Studies, the USDA Economic Research Service, and the World Bank. This isn't hidden, it's not secret, it's just not dramatic enough for most people to notice. It doesn't fit into a 30-second news clip, it doesn't generate clicks, so it gets ignored. And yes, some of the early media claims about Chinese land grabs were exaggerated. Headlines screamed about China buying all of Africa's farmland. The reality was far smaller. Media loves a scary story, I get it, but the fact that the farmland narrative was overblown doesn't mean the infrastructure strategy is fake. If anything, the farmland distraction helped. While everyone was arguing about farms, China was quietly locking down ports and railways. Here's my argument to skeptics. Even if I'm half wrong, even if China's strategy is less coordinated than I think, even if some of these deals fail, even if the Belt and Road Initiative doesn't achieve everything Beijing hopes, the risk is still real, because whether it's intentional empire building or just aggressive, state-backed capitalism, the result is the same. One country gaining control over a disproportionate share of critical global infrastructure. And history shows us what happens when power becomes concentrated. It doesn't lead to stability, it leads to leverage. And leverage gets used. You can dismiss this as doom content if you want, but doom content makes predictions without evidence. I'm showing you deals that already happened, infrastructure that's already built, debt that's already owed. This isn't prediction, it's observation. The only question is whether you're going to pay attention before it affects you or after. So here's where we are. China isn't buying the world's land because they want to farm it. They're buying control. Over ports, over railways, over supply chains, over the systems that move food, energy, and goods across continents. This isn't a crisis, not yet. But it's a shift, a reordering. And shifts like this don't happen peacefully. They happen through pressure, through leverage, through countries realizing too late that they sold more than they thought. You can't stop this. You're not a nation state. You don't control trade policy, but you can see it. You can position yourself accordingly. You can stop assuming the world will stay the same just because it's been stable for the last 20 years. Because the last 20 years were an anomaly. Pax Americana, uncontested US dominance, globalization without friction. That era is ending. What's coming next looks a lot more like the previous 200 years. Competition, spheres of influence, empires that don't call themselves empires but function the same way. If you want to stay ahead of this, if you want to track how this plays out in real time, how the debt traps spring, how the infrastructure converts into leverage, subscribe. This channel exists to see the patterns before they become headlines, to connect the dots before the mainstream media figures out there's a story. And if you know someone who thinks their savings are safe just because they're in a bank, someone who assumes the system will always protect them, someone who doesn't understand that wealth isn't just about numbers in an account, but about which system those numbers exist in, share this with them. Because safety isn't a guarantee, it's a bet. And right now, the odds are shifting.